Hello again, everybody. How are you doing? A new week, a new adventure with us, with FX Educast, with the QTime FX, and with your host, Munther Marji. I hope everybody had a great weekend, that you had so much fun. Hello again, everybody. How are you doing? A new week, a new adventure with us. Sorry about that. I forgot to mute the other laptop. Welcome again. I really hope that you had a wonderful weekend, that you spent some good times to enjoy and celebrate the profit that we made last week. It was a good week. The market moved in the direction we were expecting on so many fronts. The pound, the yen, the euro, gold. And we are really hoping that what happened last week to the American dollar is only the beginning. So maybe we will be moving in the same direction that we saw last week, American dollar weakness, for a pretty long time on the medium term. This is something that I am really opening my eyes, looking for evidence to support, of course, or to negate before I commit myself to positions in this direction. But currently, and from what I'm seeing on the charts of so many instruments, this is the direction that I am expecting, and this is the direction that I favor for the current time. But of course, that does not mean that we can expect one direction to move without any moves in the other direction. Of course, we need to see, for example, on euro, on gold, we need to see higher highs and higher lows. So we'll be making lows, but what we need to see is, of course, that these lows are higher than the previous ones. This is how you build an uptrend, and step by step, of course, that's going to happen if our expectations is correct, if this prediction is correct. Step by step, we are going to move in the right direction, and we are going, of course, to follow that very, very closely on the chart. We're going to start today, of course, as usual, with analyzing the market. But one thing that is going to change for this week is that during the analysis session, we're going to take maybe 15 minutes or something like that each hour to talk about a strategy, a trading strategy that I will be explaining to you, because as I told you guys, I told you last week and I'm telling you again, I don't want to just give you a fish, I want to teach you how to fish, and this is a step in that direction. FX Educast, QTime, and me, QTime FX, sorry, and me, we all agreed to this. We said we should give some strategy during the analysis session. So we are going to try this week and fit that in, and if that works well, we are going to do that often. So guys, with this being said, first of all, I want to welcome everybody with us. Honey, that's a fantastic name. I love that name. Ark Alolt, I hope I'm saying that right. Welcome, guys. Very happy to have you with us. And of course, we are going to immediately jump on the chart. So let me open my chart and switch to the screen. Okay, guys, I want to focus on the chart for a minute, and I want to show you something. Here, sorry about that. Okay, tell me, what do you see here? Can anybody tell me what's the big thing that makes you interested in this chart, or something that you see and it leaves you favoring one side over the other? Can anybody tell me? I'm going to give you 15 minutes, maybe 20 minutes, maybe seconds, 15 seconds, 20 seconds, 30 seconds. You have to excuse me, it's still 8 a.m. here. I'm still trying to shake the weekend mood off. You know, I enjoyed the weekend very much this time. I had a lot of great times. I had so much fun. So I'm still, obviously, I think it's obvious, I'm still in the weekend mood, but of course, I'm gonna shift to the hard working mood and mode very, very shortly. So, guys, let's hit the charts and you tell me, guys, do you see something that really favors one side over the other, one direction over the other? If so, please let me know. Any answers? Anybody who thought of something that really looks that favors one side over the other? Okay, then I will be answering that. Well, as you see, guys, we have an ABC pattern, a huge ABC pattern on the chart that started with the high seen almost exactly 1 month ago. And that is, of course, on October 18th. Today is November 18th. We saw the highest price for the euro in more than 2 months back then. And now, of course, we are a little bit below that. So the drop from that high, this is what I'm really interested in. The drop from that high came in the shape of a 3. And if you are an Elliott wave analyst, you know that 3s are corrections. And to support that with more evidence on the chart, I want to show you previous examples of how an ABC to the downside led to a move to the upside. As you see, guys, it's not only the big ABC that is on the chart here, but this is the ABC, of course, I'm talking about. But we do have ABCs that appeared before that. This one is very nice looking one, and this one is also very nice looking one. I'm going to show you why is that, why they are very attractive to me. First of all, let me switch this to the 50% level. Look at this, guys. You can see what happened here. Okay, so we were rising, we dropped an ABC, 1, 2, 3, obvious 3 move to the downside, terminating extremely close to the 50% level. This was the first sign. I remember this very vividly. When I saw this happening, this was the first reason to believe that the euro could actually recover after reaching 108.78, its lowest price in 29 months. So when I just saw this, an ABC to the downside, bottoming very close to 50% level, I started believing. I really remember this. And again, guys, it happened again here, confirming that the direction is to the upside. Again, this time it's not the 50%, the 61.8%. We were pips away from that. Only pips. And then we continue to the upside. So as you can see, when an ABC bottoms very close to a retracement level, the direction resumes against the direction of the ABC. So that means, of course, that the ABC is a corrective pattern. And of course, that's a very well-known fact in Elliott wave world. If you guys, any one of you who knows their Elliott wave would of course agree with that. ABC bottoming very close to a retracement level, that is an evidence of a move to the upside. And of course, vice versa. If we have an ABC pointing to the upside, topping at a retracement level or very close to a retracement level, then that means probably the price is going to move to the downside. So in our case here, the euro is lucky to have 3 ABC patterns pointing to the downside, confirming, of course, that the main direction is to the upside. And it happened again here, of course, on a much larger scale. You can see the size of these ABCs. not very huge, but compared to this one, it is really, really something. And of course, guys, you know that, I'm sure you know that technical analysis works perfectly on each frame, on each size. If you have an ABC pattern on the 5-minute chart or on the monthly chart, the analysis is the same, but the difference, of course, in the size of the next move expected. So when you see a larger pattern, that, of course, this is common sense, it's not technical analysis, you would expect a larger move in the direction that that pattern expects or points to. So here with these moves, with these ABCs, the moves were relatively comparable to the size of the ABC patterns. And of course, we are expecting the same here. This is a larger pattern, and we expect a large move to the upside. And the fact that this is, of course, one of the things that are very important to say, but the fact we said here, we compared the bottom of the ABC to retracement levels, and we found them to be very close. Now, just take a look at this, guys. Just take a look at this. 61.8 retracement level. 61.8 retracement. Here it is. Very, very close. It's 109.95. And we got only pips below that last week. The low was 88. Only 7 pips below that. And boom, we started recovering. And as you can see, the move after touching the Fibonacci level with an ABC pattern, of course, is in the direction we are expecting. This was a huge victory for technical analysis first and foremost, and of course for the euro, for the bulls, for this technique in specific, using the ABC with retracement levels. It is one of my most favorite trading techniques, guys. When I see an ABC bottoming or topping, of course, very close to retracement level, then that is an indication of reversal. Here's the ABC. The ABC is pointing to the downside. A reversal, that means it's going to be to the upside. And I really hope that you guys, this is not only an analysis session. As you can see, you are learning something here. You are learning about technical analysis as well, something that you can use time after time after time in your analysis. Okay, guys, now I'm just gonna update the chat URL so I stay connected with you guys, and it's working perfect. This is great. Now back to the chart. So this is it, guys. The euro is in a perfect situation to achieve gains against the dollar, and we expect that to happen. But of course, after recovering from last week's low, which was extremely close to the Fibonacci level here, what is now happening is that I'm going to delete this retracement so you don't get confused. I'm going to draw retracement level. Of course, the best way to draw it is from the top of wave C, but I prefer to draw it for the whole ABC, and I understand if some of you guys don't think that that's the right way to do it. Well, it is of course up to you. There are no 100% hard rules on the subject, so I always prefer, or not always, sometimes I prefer to use the whole move, the whole ABC, and calculate retracement only, not only for the C wave, but for the ABC. Other analysts may tell you that you need to calculate that only for the C wave, which means starting from here, not starting from here. In our case here, the difference is marginal because the starting point of wave A and wave C are very close to each other, so it will be only a couple of pips on each level, not very important. But when there is a difference, of course you have the option of calculating the retracement levels for only wave C, which is more common between analysts, or for the whole ABC pattern, which is what some analysts do, like myself. Sometimes I do that. Of course, I always look for reasons to favor one over the other. I look at the chart. What I find there is what tells me, okay, this time you need to calculate it only for the C wave. No, this time calculate it for the whole ABC pattern. So one of the reasons why I favor calculating it this time for the whole ABC pattern is the high that was seen overnight during the agent session. The high is 64.6, while the Fibonacci level, if you calculate it for the whole ABC pattern, is at 1062. So with this, of course, these two levels extremely close to each other. I am favoring, of course, to calculate the retracement level or levels for the whole ABC pattern. And that leaves us, of course, with 62. I think it's 63 if I'm not mistaken. No, it is 62. It is 62, yes, guys. So it is 62. Actually, it's 62 point something. So 62, 63, well, we're not going to fight about that. Consider it 63 here. I'm going to consider it 63. So the first thing I want you to note is that resistance is at 1063. And what a surprise. Remember, guys, on the way down, this number came up in so many sessions. We had a support at 1063. It was a retracement level. And then we had many daily lows very close to that level. If you remember, do you remember that? Yes, I'm sure you do. You can remember that here we have a daily low very close to that here. We had lows something like 71. Here it was 67. Here 62. Here 63 exactly, and so on. So this level here, the 63, was a support when we were moving to the downside, and now it has become a resistance, not only by the previous daily highs and lows, but also by the Fibonacci retracement for the whole ABC pattern, which is the Fibonacci, of course, 38.2 level is at 1063. So without a doubt in my mind, the first resistance we need to care about for today is 1063, and keep that in mind. Now for the support, of course, I need the resistance support before I can build a strategy. You know my way, you know how I do things. And so if you want to follow my way, then you must find a support. Now we have a resistance, we find a support, and then we build our strategy on breaking one of them. The whole strategy is built on the break possibility. So we are surrounded by two levels. This is what I usually do. And of course, if you are coming back, if this is not your first webinar, you know that. You know how I do things. I find a resistance that I believe that it is the most important resistance for the time being, for the current prices. And of course, I find the support that I really believe it is the most important support for the time being, for the current prices. And then, of course, if one of them is broken, I follow the direction of the break. This is how I build my strategy. The trick here is, of course, it's a very simple technique. It's a very, very simple technique. And that is why some people have doubts. In my seminars and my training courses, I meet people who are asking me, well, that's very simple. Do you think that with such a very simple technique, you can make money in the market? It's a huge market. You need something that is more complex than that. I totally disagree. You do not need a complex system to make profit in the market. But there's a trick, of course. The trick is to specify the best, most relevant, most important support and the best, most relevant, most important resistance. If you do, then you're a good analyst. You know your key levels, and you know when they are broken that you have a chance, an opportunity to make profit in the market. But of course, that needs a lot of experience, that needs a lot of education, that needs a lot of factors. For example, you can use retracement levels, previous tops and bottoms in sessions, or daily highs, daily lows, and of course trend lines, moving averages. You have to use all of these tools together and be smart enough to pick one of the levels that these tools are pointing towards, because of course we don't have only one support and one resistance. If that was the case, things will be much easier for us traders, but they are not. They are not. That's why 80% of people lose money in the market, because it's not very easy to specify which one among these levels is the most important. Of course, if you get any analyst on a chart, they are going to come back to you with resistance levels, many resistance levels, several support levels. But which one is among these resistance and support levels, which one resistance and which one support are the ones that you need to follow a break of? This is the trick. This is something that you need years of experience to get to know, reading tens of books and applying, of course, many times on the chart until you get the required skill to do so. So I really hope each and every one of you guys get that skill with time. Of course, it's not something that you acquire immediately. You need time, you need experience, and you need education. That's why you're here. I'm sure some of you guys are interested in knowing not only where to buy and where to sell, but how to do that. And this is exactly what FX Educast is doing for you this week. We are going to talk about some trading techniques that you can use at any time, not only where to buy and where to sell for today. No, I'm going to give you something that you can use all the time. Okay, guys. So with this being said, it's obvious that we have a resistance at 1063. The support will continue to be 109.95. Of course, it's a very important support, but there is a closer support that I'm interested in. I'm going to show you that in just a minute. But let me leave this on the chart. I really want you guys to realize that these are the levels that you need to watch for today. And one of the support levels that can be found before 109.95 is the 38.2 retracement level for this recovery attempt. After reaching 109.88 last week, we started moving to the upside, which was extremely expected. It was heavily supported on the chart that we rebound from 109.95. And we did. So now that left behind, this recovery attempt left behind the Fibonacci level, the first Fibonacci level at 1035. Why 1035? Why not the 50% level or 61.8? Why is this the one that I favor to others? First of all, it is the one closest to the moving average band, at least to the top of the moving average band. That's why if I see the price today around 1035, I would be in little doubt that I should open a long position, and I'm gonna. And that's why I'm gonna issue a recommendation for you to do just that. Now, another reason is that we do have session highs and lows very close to that level, seen last week and even the week before. Let me show you. This is the 35. Look at this here. We are very close to it. And look at this here. This is the daily low from not this Thursday, the one before, November 7th. And here we have the highs of the 11th and the 12th, very close to this level. In addition, of course, to it being a Fibonacci level, the first Fibonacci level. If we want to move to the upside and the atmosphere is very positive like it is here, we do not need to retrace a lot of the previous move. We prefer to see 38% or 50%. We don't want to go to the 61 or 78 or 88 retracement levels. And that's another reason why I favor 38.2 for now. So, of course, this is a key support. This is very important, and this was obvious in the trading scene last week. But I'm going to give you an initial support, let me call it. Initial support at 1035. So what I'm going to do today is that I'm going to issue 3 trading recommendations. If we break above the resistance, I want to be long. I want to buy. If we fall to the initial support, I also want to buy. But in case a surprise happens and we break below the key support, of course, I want to be short. I don't want to be holding on to a long position. So let's start immediately with the strategy. I'm going to leave these on the chart for you guys. I'm going to say hi to Blaine. Blaine, how are you, buddy? I'm very happy that you were making money on Friday. Yeah, last week, almost every day we made money. It was good. It was a good week. I'm very happy for it. Congratulations, buddy. Kudos on this profit. And Nick, good day to you too. Good day to you too. Michael is keeping attendance. That's very nice. I like that, Michael. You keep an eye on everybody. Okay. Okay, guys. So let's immediately start with the strategy. Of course, I favor the long today. I'm going to continue to favor the long positions unless a surprise happens and 109.95 is broken to the downside. Currently, of course, if we top in the 60s, we need to be careful because we'll be topping at a Fibonacci level here, the 1063. It's the resistance. So as long as the daily high is very close to 1063, we need to be careful. Okay, but that of course does not mean we cannot drop a little bit. So dropping to the 30s today is perfectly fine. In fact, it is better, healthier for more gains. So if we drop to the 1030s, we find support there, and we start rising again, that is actually better than to keep trading around current levels for a long time. So I don't want to be in the 60s all day. It's okay. It's completely fine to drop towards 1035, find a bottom there and start rising. That means that we have another leg to the upside. And of course, it comes with a promise of higher highs. So if we break 1063, of course, the resistance is 1063. So I'm going to place my buy order 10 pips above that. My stop, it should be below 109.95. Of course, that would leave me with a large stop. 10 pips below that, although I don't prefer 10 pips, but maybe because of risk management reasons, I don't want to have a stop that is more than 100 pips. I don't like that at all. I don't like doing that. So my maximum stop is always below. I don't want it to reach 100 pips. 95 is okay, 99 is okay, but when it reaches 100, I feel like this hit. So maybe 75, yeah, 20 pips. 75 who are still below 100 pips. So 20 pips below 109.95 and we give up. Our long is at 1073. I'm going to give you, of course, 2 targets like we have been doing for a while now. Initial target, I want you to have a target that is not very far, that is in the round of 35 to 50 pips, which means I want it to be just above 111. Let me look for a target. So 73 at 11 we'll be making 27 pips. No, we want more than that. 11.15, something like that, that would be great. To me, these bottoms here are not bad looking at all, especially with this high here. This is, I think this is 27. So, of course, we also have another reason to believe in this level, 11.27, and that is the retracement for this whole move. This retracement for the whole ABC. Look at this, one of my absolute favorite levels is the 71.4, and it is at 11.27 with these lows here, with this failure here, with these highs here. I really believe that 11.27 is an important resistance for today. If we start rising, we're going to keep our eye on that level, and of course we're going to have a better target. Remember, exactly 1 month ago, today is November 18th, October 18th, we had a 2-month high at 11.83. I'm going to use it as my second target for the day. Of course, I'm going to color that in blue. Now you know my color code. What about the other buy signal? If we drop towards the 30s, I want to be long as well. So 10.35. Now the stop can be lowered a little bit because it's a better entry point for a long position. So I'm going to add 10 pips to that stop. And of course, if we bottom in the 30s, that means that we are going to reach higher highs than the one seen overnight. The agent session high is 64.6, let's say 65, 1065. How about adding only 10 pips to that? We need to get above it. Of course, if we find support in the 30s, that means the chances of reaching a higher high above the agent session are good. Why is that? Because this is a retracement level, and finding bottoms very close to retracement levels means the drops are corrective. When a drop is corrective from the session high, this means that we should expect the price to reach above this same session high. So I'm going to put only 10 pips above that and get my first target, target 1 at 1075, 40 pips, and target 2 is going to be, of course, ambitious. I want it to be more than that. How about 1127, the initial target for we still have a short. We need to talk about the short recommendation. I really hope the short recommendation will not be hit, but of course, we are traders, guys. We are not married to sides of the market. The side that makes us money, we should follow. We do not believe that I'm only going to buy the euro. Well, yeah, we prefer to do that. But what if your support is broken? Are you going to continue buying the euro? This question can determine if you will be a good trader or not. If you are a trader who takes sides and believes in bias all the time, even when you see evidence on the chart against your beliefs, against your expectations, your analysis, then you will be suffering in this market. But if you are the kind of dynamic guy who changes his mind when the chart changes, the evidence, the observations on the chart are the ones that you should follow, not your feelings, not your human nature. Okay, so if 109.95 is broken, guys, we need to say, well, not this time, euro. We love you. We want you to go up. The setup is very good, but because you broke below 109.95, we believe that you need some time. You need to look for a lower low, maybe another bottom, another support before you can recover. So selling when 109.95 is broken makes absolutely perfect sense according to technical analysis and to what the chart is saying. So that is why I am, but of course, It's an important level, so we're not gonna rush to a short position. We need to see a good number of pips below this level before we initiate a short position. I'm gonna use 30, guys. I'm gonna use 30 pips below our important level, and that of course leaves us at 109.65. 109.65. Now if we go back above that same level with 30 pips, I can place my stop there. So it is let's say 10.25. How about that? 60 pips of stop. Fantastic thing. Last week we talked about a very attractive target at 109.03. Do you remember that, guys? We said that if you take a look at the chart, you will find that around 109.95, sorry, 109.03, we do have as support, and it's here and here, guys. It's very obvious. This is the 109.03, and also we said that we have a long-term Fibonacci level at 108.14. So these are my targets for short position, although I really don't want the short position to be triggered. That is bias, but it is bias that is based on the chart, guys. I'm not building this view of what is going to happen to the euro solely on what I like and don't like. No. It's not like that at all. What I do is, of course, that I look at the chart, and after looking at the chart, I, of course, favor one side over the other. So the chart picks my side, not my feelings, not my human nature, not my intuition, or these things don't work in the market, believe me. So guys, let's go to our QTimeFX trading platform and immediately start placing these orders. We are in the 60s now. I'm gonna place a buy stop first at 10.73, and let me look here. Our stop is 109.75, and our limit is 11.27. I'm gonna use the first target for you guys on each of these orders. If you feel you want to wait until the second target, that's perfectly fine. But of course, if the market moves in the direction we are expecting and we are making profit, what I want you to do is to update the stop. So we start with a stop that is here. In this case, it is 98 pips. That's a lot. It's almost at the maximum stop that we are willing to accept. At least this is what I do. I don't go above 100 at all. Unless of course I lower the trading size. I don't want to do that here. I want to be in with one lot, and I want to keep my stop below 100. So guys, this is the first order. Of course, guys, if you use 11.27, that's okay, but if you want to use 11.83, that's also great. Just update the stop. It's at 98. Don't leave it at 98. When we make profit, when the profit is 40 pips or something like that, 40, 45, 50, move it to a very small amount of profit, 5, 10 pips, something like that. And of course, if the market continues to move the direction you like, then update the stop accordingly. Now, second order is going to be a buy limit, of course, at which price? Of course, 10.35. I really hope that this is the one that gets triggered. Our stop is 109.65, and our I think it's 75. Yes, it is 10.75. Limit at 10.75 and place. And of course, just in case the surprise happens, we want to be there to take advantage of it. Sell stop at 109.65, Let me see, where is the stop and limit? Our stop is 10.25, 60 pips, very reasonable stop. This is the ideal level for stop, 60 to 70. This is what I really like. And our limit is, of course, 109.03, which obviously looks like an important support and place. Yes, so now we are ready to use any break of the resistance or the support. Resistance at 1063, support at 109.95 continues to be there for one more day. Or we do have a third order for today. If we drop towards the initial support 1035, we want to be long as well. With this, guys, we are going to take now a pause from the chart and allow me to talk a little bit about a strategy that I want you to know about. And okay, there you go, guys. So trading techniques or strategies, they are something that I know you guys love. They make you feel like you understand the market more. Of course, when I tell you buy here, sell here, and you make profit, you are happy. But you are still counting on someone else. You are counting on an analyst, an experienced trader to guide you in your way in the market. But of course, when you are told that this is a strategy that you can use with you, that you can take from here, you can take what you learn and you can use it every day of your trading. I'm sure that makes you feel like you understand the market better. It's not just someone telling me where to buy and where to sell. Now I'm going to follow these instructions in order to know, or at least to try to know, where the market is going to provide us with good trading opportunities. So I love doing this, guys. I love it. And I love explaining strategies to you. And we are going to divide this strategy. It needs maybe 40 minutes to explain with examples and so. I'm going to divide it over the 3 hours of our analysis session. So let's start. Today, what I'm going to talk about is my moving average strategy. And I have said this before, I know I did. I said many times, guys, that my story as a trader, when I started trading 19 years ago, next month they are going to be exactly 19 years ago, what I used to believe is that we traders should look for turning points, should look for tops and bottoms to use in our trading. And of course, that meant that we should use, maybe when I first met the indicators, what I preferred was to use oscillators, which show me the overbought and oversold areas. And of course, when it's overbought, that means we are probably going to top. When it's oversold, that is an opportunity for a bottom. So I wanted to pick tops and bottoms. This is what I really believed in as a beginner. And that's why my relationship with the moving average was not good at the beginning. I said to myself, well, it is an indicator that gives you the signals too late, after the market has moved. And I prefer, no, I prefer an oscillator that gives me the entry points at a much earlier stage. That's why I fell in love with indicators like RSI from the very beginning, but I had a rough relationship with the moving averages. Now, guys, that is the thinking of a beginner, okay? Why am I saying that? Well, after many years of using the indicators and taking a look at them, my view towards the moving average changed completely. So from someone who did not like this indicator to someone who really believed in its strength. This is the change that happened to me over the years and with experience. And of course, you need experience to feel that you understand more and more about what you are doing. So without experience, I had one opinion about indicators, which of course said that moving averages, they are too late for me. You need the market to move, and after moving 60, 70, 80 pips, that's when these indicators give you the sign to get in. As a beginner, I said, well, that's too late. I want to pick the top and pick the bottom. Of course, picking tops and bottoms means one very important thing. This is something that not a lot of people understand. It means that you are trading against the trend. Does that make sense? Of course, a lot of people it does, but to me it does not. Trying to pick tops and bottoms, sometimes it's very exciting, of course. We are human beings, we love to bargain, we want to feel that we got in on a short position at the highest price possible. We made a bargain. Or we want to be in with a long that is very close to the daily low. Oh my God, you won't believe it, man. I got a long position 6 pips above the low. Can you believe that? And now we are 50 pips higher. That gives us a sense of pride. You feel great about it, but it's a very risky business because the main goal and objective of technical analysis is, of course, guys, to identify the trend and to follow the trend. We identify the trend not just because we want to identify the trend. It's not a contest here. It's not a TV show where you need to give the right answer. We identify the trend and we follow the trend. So if the trend is up, I want to be long. If the trend is down, I want to be short. But picking tops and bottoms does exactly the opposite to that. When the trend is up, you're looking for a short. When the trend is down, you're looking for a long. And that is the cause, in my own opinion, of at least 3/4 of the losses that traders suffer from. So you position yourself against the direction of the main trend, and that does not make sense at all. So this strategy today, what I'm going to teach you in each hour, we're going to talk about it for 15 to 20 minutes during each hour, is this. I'm going to teach you how to use an indicator that keeps you on the right side of the market. It keeps you moving in the direction of the market. Okay? In the direction, of course, which that means the trend. So if the direction of the market is up, if the trend is up, this indicator keeps you long. It does not give you a short signal. And of course, if the trend is down, it keeps you short. It keeps you always on the right side of the market. So guys, this is an indicator that's different from the RSI, stochastics, MACD. Of course, I know you like seeing these things generate long and short positions, long and short signals. When there's a cross on the stochastic, I know a lot of people are very excited. Let's get in. RSI recovering from the extreme areas towards the equilibrium level. Of course, that gets you excited. I completely understand that. But what I want you to do is just to give the moving average a chance. Don't go looking for tops and bottoms, and if the market is rising 100 pips, you want to sell. I understand that as a part of human nature. We love to bargain. But as a trader, of course, I'm against that. Or at least 99% of the time I'm against that. Maybe once every 5 or 6 months I try to do that. But I don't want to be buying when the trend is down. I don't want to be selling when the trend is up. I want to follow the trend. I want to go with the trend. And that is what I want you to do, guys. So with this, consider this an introduction for now. We're going to continue talking about my moving average strategy during the second hour. And for the time being, guys, we are going to take our first break of the day, and after that, we still have more analysis. And of course, the second part of our strategy series, let me call it, is we're going to have 3 episodes every day. Each of them is about 15 minutes, 20 minutes to talk about one strategy. So in the next hour, second hour, I'm gonna also talk about the moving average strategy. And in the third hour, I'm gonna show you examples on live chart on how to use that strategy. And that's the best part. So stay tuned. I promise you, you're gonna like this strategy. Promise you, it will generate you trading signals that a lot of people will not see. A lot of people will be looking to buy, and you know that the market's going down, so you sell. So you are moving against the vast majority of the people. Unfortunately, I'm saying this with regret, with sadness, when I see people trying to position themselves against the direction of the main trend. Guys, I really find that to be, it is just painful. Because why are you doing this for some quick profit or for the chance to make real money? Okay, when you follow the trend, that is exactly what you're going to do. So why you are always trying to position yourselves against the trend? So I really hope that, guys, you will love the strategy. Consider this only an introduction for now, because I'm gonna split this into all over the 3 hours, so you won't get bored from talking about the strategy for a whole hour. Instead of that, no, we're going to talk about it for 15 to 20 minutes every hour. And with this, guys, I really love to see you after the break. I'm gonna take a short break, 5, 6, 7 minutes, something like that, and after that we will be back with much more, guys. So see you in 5. Okay, guys, welcome back again. Thank you for being here. How's everybody? How was your break? I hope you had something to drink or thought about the market a little bit. If you have any question at any time, what I want you to do is to post that on the chat, and I'm going to get back to you. So you guys, any question about the market, any question about the recommendations we are giving, or in today's new order, we have a strategy we are talking about. So if you have any question about that, please shoot, and I will be answering that with a smile on my face. That's my promise to you. Okay, guys, so with that being said, let us move to the charts. These are, of course, the recommendations for the euro that we gave before the break. As you can see, I'm going to remind you of them. We are already placing these orders. We did place them on our QTime FX platform. And of course, we are waiting for one of them to be triggered. My favorite among the three is 1035. This recommendation here, if this gets triggered, I will be a very happy man. So after that, of course, we are going to now move to the precious metal. I know you like it, guys. No. You don't like it. You love it. This is something that a lot of traders ask me about all the time. Last week we had a long in the 60s. The market closed on Friday almost exactly at this level, so not a lot of profit or loss, only very few pips that were achieved with Friday recommendation. So we have, of course, we have been favoring the precious metal to move to the upside since we had that bottom very close to 1446. Let me remind you why I love what has been happening on this front recently. I'm going to use the daily chart to show you. I think I will need to delete that. I will redraw it again. But this is why, guys, I am, or let me say, this is the number one reason. There are many reasons, but this is the number one reason, the most important reason why am I a precious metal bull at the moment, just like I'm with the euro, of course. And of course, these two things go hand in hand because, these are the rivals, the real rivals of the American dollar, gold and euro. So to find on the chart that they are expected to move in the same direction together, that adds to the confidence that we have in this analysis. So for now, the main reason that I believe will push the precious metal to the upside is finding a bottom extremely close to the medium term Fibonacci 38.2 retracement level. It was 2.8 pips below this Fibonacci level. Do you believe that, guys? It is an unbelievable accurate touch. So we calculated the retracement levels for the whole rising move from the lows seen late in April and early in May, of course, up until the highest price that was seen after the rate cuts on the American dollar, which was in September. We saw the highest price for gold for many years at 1557. So we were rising, and it was an unbelievable trip, guys, from 1266 to 1557. That is just, the kind of move that can make you a real fortune if you followed the direction of this move from beginning to end, and you were managing your risk in a good way, adding to your positions. This unbelievable size of move can make you the profit that you want to make in a whole year on all currencies. You can make that with one currency. Well, it's not a currency, it's an instrument. You can make that with one instrument, guys. One instrument, if you can catch such a very fantastic, very attractive, very beautiful move like this one. To me, to tell you the truth, I was not extremely interested in gold in this area, but when they said boom, rate cut on the dollar on this day, July 31st, I became a gold bull. And of course, I made very good profit on the way up, thankfully. I'm very thankful for that. So after that, of course, guys, we saw the price moving to the downside. And the first thing that I noticed about this is, of course, the ABC. And then we have an X wave here, and we do have another ABC. It's a little bit more complex because we have moves inside the ABC that, although this felt at the beginning that it's not finished, that we can still push lower for a fifth wave, because if you count this 1, 2, 3, 4, 5, then we still need a 5, but inside this move, you can you can convince yourself that there's a 5. If you find this here as to wave 4, 1, 2, 3, 3 is divided into 5, of course, and here we have a wave 4. Although, in my opinion, it's very, very small to be compared to wave 2, but you can count it in a way to assume that C wave has completed a 5-wave sequence to the downside. However, we still have opportunity to drop lower below this Fibonacci level from an Elliott point of view, but because the bottom was extremely close to a retracement level, I think that Fibonacci analysis of the situation is very, very bullish. The Elliott wave analysis of the situation is also bullish because we have a double 3. We have a first 3, ABC, and then wave X, and then another 3, ABC twice, both of them pointing to the downside. Remember what we said when we were talking about the euro, guys. Do you remember that? When an ABC is pointing to the downside, that is an indication that trend is to the upside. So when we see two ABCs doing what they are doing on this chart, they are pointing to the downside. In my own opinion, the chances of moving to the upside are very, very good, especially that the second ABC terminated extremely close to a Fibonacci level. This is very, very important. So what happened after that? Let's switch to another chart, guys. The hourly chart. When we touched, just look at this magical touch. It was just a touch, and then boom. We did not trade in the 40s for too long after reaching this Fibonacci level. 1446, and then boom, back to the 50s, very, very fast, and then the 60s, and then the 70s. We touched the 70s for a little bit. We took a break, and I hope that we are going to the 70s, 80s this week. I really believe that we can do 80s, so we are in front of a chance to make 150 pips minimum from current levels to the upside. I really hope we do. But of course, what we need to do now is to find the support and the resistance and build a strategy on. But I wanted to show you some of the reasons why I believe why the gold is moving to the upside. Another reason, of course, is breaking above this falling trend line. I love this trend line. The slope is almost perfect. You know, the touches are very good, very convincing. The reaction from touching the trend line was good each and every time, and then we broke it. And once we broke it, we moved more than 100 pips to the upside, actually more than 150 pips to the upside above the point of the break. That is yet another indication that the market is going to the upside. And with the Fibonacci, of course, the long-term Fibonacci. And we have this candle here. I love this candle, guys. It's almost a doji or doji. I'm not sure which one. Steve Neeson says doji, but I like doji. I don't know why I like it more. That's why I keep saying doji. So doji, I don't care how you say it. What I care is how you use it. This is what I care about. How you use it in your trading. I want you to use it to make profit, to make money, to be one of the 20% that make it in this market away from losses. 80% of traders are not successful. And the rest 20%, of course, some of them are, breaking even, something like that, and some of them are making profit. So if we divide them in half, that means maybe only 10% of traders actually make money in this market. So I want you to be one of these traders. Okay, all of you, I really want everyone who's watching this to be a successful trader. But of course, it needs a lot of hard work, and you can do it. So you should know how to react to candles that mean a lot like this one. Of course, this is a bullish candle, and as you can see, the next 2 days, if you just looked at this candle and said, well, I'm buying when this closes, you buy at the close, you made very, very good profit. Okay, so many reasons on the chart to believe that the main direction is to the upside, but there's one reason. I'm going to delete everything that I wrote, everything that I've drawn, and I'm going to show you this. Well, C wave, the C wave in Elliott should be divided in 5, not 3. So up until now, we only have a 3, and this could be 4, and this could be 5. Then we can say that the C wave is over. One of the rules of Elliott is that waves 1 and 4 do not overlap. So the bottom of wave 1 is very, very important for the current technical situation. The bottom of wave 1 is October 30th low, 81.37. So I don't want the price reaching above this level if I want to see a fifth wave to the downside, which means, of course, the reverse to that is if we break above the bottom of wave A, then we can say that wave C has terminated and the 5 is done. And if you look inside on the hourly chart or something like that, you can find something to confirm that. But of course, as I said before, wave 4 looks extremely smaller than it should be compared to wave 2. This is something that usually it's a turn off for me. I want to see some kind of relation between 2 and 4. If one of them is extremely small, the other is much larger, I stay skeptical about the wave count as a whole. But nevertheless, if we start trading above 81, that means the possibility of a fifth wave to the downside is gone. It's gone, and that's it. So this is the bottom of wave 1 is currently a very, very important resistance. We need to break this in order to confirm that the precious metal is moving to the upside. And this is what we will be looking for this week. A break above 1481 would be fantastic for our bullish expectations. And the bullish expectations, of course, they are not about 100 pips or 200 pips. We're talking about much larger than that. Why is that? Let me show you why. When I say that this is a corrective pattern, ABC here, then X, then ABC, and when I say that we have bottomed very close to a Fibonacci level at 1446, that means this whole thing is a correction. It took a lot of time, but it's still a correction. And when you see a corrective pattern falling from a certain top, what you need to expect, or the right thing to expect after the termination of the corrective pattern, is for the price to go back beyond the top from which the whole correction started. The top from which the whole correction started is September 4th high 1557.1. This high, guys, 1557.1. Now we are almost 1,000 pips below that at current levels. Did you hear that, guys? 1,000 pips. Okay? So if this turns out to be a correction and it's finally terminated, what is going to happen is that we are going to reach a higher high above the top from which the correction has started, which is 1557. So we are talking about something more than 1,000 pips, guys. More than 1,000 pips. So going long on the precious metal around current levels, if we of course find the right levels to do so, can be your trade of the year. If you miss this fantastic move after the rate cut, then this is your chance to make up for that. Something very similar to this can appear and start here in the 40s. So we have two different possibilities. Of course, we always have two different possibilities, and the market, of course, is the one that picks which one it likes most, not us. It is the market, and we follow, not the other way around. The market does not follow us, we follow the market. So we are waiting for confirmations in either direction. My preferred, of course, is to the upside because of the Fibonacci bottom and the doji on the daily chart and breaking the falling trend line on the hourly chart. All of these things point to the upside. Now let us find what levels, what support and resistance we can use today to build our trading strategy. This does not look good to me at all. Of course, you know, this is a very small 4, but nevertheless, as I said to you, if we are still below 1481, a chance of another low is going to be there. But if we break above 1481, that chance will disappear. So where are our levels? Let me remove all drawing tools and just focus on this last part. As you can see, we are already trading below the moving average band, which of course indicates a move to the downside. But this move, of course, it does not have to be destructive. It can be, on the contrary, it can be very positive. It can be a healthy correction, after which the price resumes moving to the upside, especially that up until now we are seeing a 3-wave setup. So one of the things that I always do is to calculate the size of A and look for the equality target between C and A. This is one of the guidelines of Elliott wave. A and C usually are approximately the same size, and that is something that I saw tens upon hundreds of times on the charts all through these years. When C reaches the same size as A, there's a good possibility of reversal. So I'm going to calculate, guys, the size of wave A. It started at 74.6 and stretched down to 62.2. So it's 124 pips. 124 pips down from this level, which is 69.6, 124, 57.2. So equality target. Of course, it does not have to be down to the pip. You know, we're talking about approximation between the two waves. So equality target when A equals C is 1457.2. Now, this is very important. So I'm going to draw a line at 1457.2, which is here. And as you can see, guys, this equality target is very, very close to the Fibonacci 61.8 level at 56.6, only 6 pips between them. So in these 6 pips, we could find what we need in order to recharge and attack the upside again. Another support that I'm interested in is, of course, 53.8, which is the 71.4 retracement level. So I'm gonna completely forget about the 38.2. Of course, we are already below that, a few pips below it. Now the 50% is at 60. We cannot, of course, neglect that, especially with this high here, with this low here. So the 60 is important, but my favorite support for today is the area between the equality target and the Fibonacci 61.8 for this recovery attempt. Which was 1456.6. So this means, of course, that support is at 1456.6 to 1457.2. 6 pips. In these 6 pips between this horizontal support line and this retracement level, we have a very good opportunity of reversing to the upside. So I'm not going to buy gold here, guys. I'm going to wait for it to drop to these levels. So if we see the price around these levels, we need to be long. This is the first idea that we are going to go with. Of course, we need to place our stop below the 71.4, which is 1453, and this is, of course, let me call it backup support. Backup support at 53.8, right? Yes. Okay, so now we have a support to buy at and another support to hide our stop below. And of course, what if the price starts moving to the upside before it reaches our equality target or Fibonacci level? In this case, I want to look for a resistance to buy at. In my opinion, the resistance should be this falling trend line from the top of the recovery attempt. And as you can see, it's very close to the moving average band here. Currently, at the current hour, it is 68.1. Of course, it's going to drop 1 or 2 pips every hour. So for now, I'm gonna consider it to be at the top of the moving average, which is 67.4. So resistance. $67.4. So these are the levels that I'm gonna use to build my trading strategy for today. If we drop towards the support, I want to be long. If we break above the resistance, I want to be long. If we break the backup support, then I want to be at least out of the long, even if I don't want to sell, maybe for obvious reasons that the precious metal is, creating ABCs to the downside, finding support at Fibonacci levels. That may be something that a lot of traders, a lot of analysts see as, well, I don't want to short this thing. And I really believe you should not, at least for today, until further notice, we are not going to sell gold because we have many observations on the chart supporting a move to the upside, a considerable and strong move to the upside on the medium term, not only on the short term. So I don't want to be positioned against these observations that appear on the hourly, 4-hour, and daily chart. On all these charts, gold is very well supported. So I'm going to look to buy today only. The first is, of course, if we drop to this support, I'm going to use the top of the support area as an entry, 57.2. My stop, of course, guys, should be below the backup support. And I'm going to use 30 pips below that. Let's make it 40. 49.8. Yeah, 74 pips is very good for gold. And now the targets, target 1 and target 2. Target 1, I'm gonna give you a modest target. How about the bottom of wave A? The bottom of wave A is 62.2. 62.2, 50 pips exactly from our entry. And the second target, I want it to be something much more exciting. And instead of 62, I'm going to add more than 100 pips to that. I'm going to use the top of the recovery attempt at 74.6. as two targets. I'm gonna use blue for my long positions or long recommendations, and red for my okay, for my short recommendations. Okay, now the other possibility is that if we break the resistance or attempt to break the resistance without reaching the support, and 10 pips above the resistance is enough for me. 68.4, we get in. Now the stop on this one is a little bit tricky, because if you want to follow what the chart is saying, the stop's going to be huge. But we're not going to wait for the break below the support itself. I'm going to place it below the bottom of wave A, which is 62.2. Let's say 30 pips below that. 59.2. Yeah, we are still below 100. That's good enough for me. Although it's 92 pips, it's okay. Now for the targets, of course. Target 1. I want to use something that is not very far, and in this case 74.6 would do good. That is 62 pips. Yeah, not very far, but I want target 2 to be 1482. Okay, it is the level that if we reach will confirm that the whole drop is, at least would favor that the whole drop is now terminated, because now we have overlapping between 1 and 4, and we cannot count them at 1, 2, 3 as 1, 2, 3, 4, 5. So we count them as A, B, C, and then boom, that's done. The correction to the downside is done, and market move to the upside should be expected for hundreds of pips. So that's 1481 point something was a very important level. Let me just recheck. Yeah, this low here. This low. This is the bottom of wave 1, not this one. This one. Let me check. What price do we have here? Actually, 83.4 makes a fantastic target. So I'm going to adjust this just a little bit to 83.4. There you go, guys. This is what we have for gold today. And I'm going to, of course, immediately place that on my QTimeFX account. I would really, really like it very much if we dropped towards 1457 and then started recovering from there. If you see the price bottoming around 57.2 to 56.6, this area here, very close to it, that would be fantastic for the short term. Fantastic. That would mean that we are before a move that is going to be in hundreds of pips to the upside, and probably it's not going to take a very long time to reach its targets. So let's place these orders. Buy limit at 1457.2. Good. Our stop was 49.8. 74 pips. Reasonable stop. And our limit, I'm going to use, I'm going to use the second one on this one. I'm sorry, guys. If you want to use 62.2, go ahead. but I'm going to place my limit at 74.6 because if we bottom here, it's going to be extremely promising. 1474.6. And place. There you go, guys. This is the first recommendation for today. The second one is, of course, the one that would be ready to use a move to the upside without reaching this support here. If we start trading above 67.4, we want to be getting ourselves a long position, and that of course means that we need to place a buy stop at 1468.4. Stop 59.2. And the limit is, for this one, I'm going to use 1474.6 as well. So it's the same limit for both entries. This one, I would be happy to get away with this kind of profit. But if we bottom around our support, I would expect a stronger move to the upside. And done, guys. This is our second recommendations for gold today. Two recommendations, both long, no short recommendation on gold today. And keep your fingers crossed. I have a strong feeling that tomorrow, when we come back to talk about the market, one of them is going to be hitting its limit by then. So, guys, with this, we are going to continue talking about the strategy for today. Moving averages. Of course, I'm gonna tell you how I use the moving averages. That's why this slide shows the title, My Moving Average Strategies. This is how I use it. Of course, different analysts have different using methods for moving averages, but of course, the main idea is the same. You know, when you fail to break, to cross, not to break, this is the right word. When you fail to cross above or below moving averages, that indicates reversal. When you cross above them or below them, that indicates a move in the direction of the cross. To me, you know, both are very good, but I prefer the failure. That's what I focus on. I focus on the failure to cross above or below moving average. First, I want you to understand that moving averages are dynamic support and resistance levels. We always look for ways to identify support and resistance levels. And we use, of course, trend lines, horizontal support and resistance levels. We look for daily highs, daily lows, session highs, session lows. We calculate retracement levels. So we have a lot of tools that help us identify support and resistance. One of the most favorite tools that I use to identify support and resistance is moving averages. This is a tool that you should respect, you should use. It's highly recommended. Everybody loves the moving averages, especially, of course, people with enough experience in the market. As I said before, as a beginner, I wanted something to help me pick tops and bottoms, but as I grew wiser, and I still grow wiser in the market, there's no end to learning. So even after 19 years, I'm still learning, of course. So I grew wiser, and I grow wiser every day when I see the tools that I use, when they are making me great entries, great trades. Of course, I learn from that. And when I fail to spot the best opportunities in the market and the market moves against my expectations, of course, I learn something from that as well. So we continue to grow wiser every day as traders. And as you grow wiser, you will have more respect for moving averages compared to what you had when you were a beginner. So my main idea here is that failure at these support or resistance levels is usually an indication of reversal. So I'm going to focus on the failure, not on the cross in today's strategy. Keep in mind, although sometimes it looks like magic, It is support and resistance. It is not magic. We should treat them like we treat any other support or resistance and estimate the chances of them holding or breaking in the same way. So to me, I prefer, of course, to find, as I said before, the failure. I focus on the failure, not the cross. And this is what we are going to talk about today. And always, guys, of course, when I explain to you about any technical technique, any tool, I want you to use the power of technical confirmation. What I mean by that is, do not use the signal generated by only one tool. I don't want you to do that. I want you to use many tools together. And when you have a number of tools pointing in the same direction, you have yourself a trading setup. So guys, of course, I did not want to spend a lot of time on this slide. I just wanted you to understand the power of technical confirmation. Of course, you can use any other tool, any two tools together, three tools together, and when they point in the same direction, that means you can go with that direction with confidence. Even if we have the moving averages pointing to a certain area as an important support or resistance area, we need to check other things on the chart, like previous tops and bottoms. If we have a top or a bottom or a number of tops and bottoms very close to the area suggested by the moving average, that of course means we have a better chance of this area surviving. Retracement levels. You know how I love my retracement levels. This is a tool I use every day, maybe 20 times. So it is something that I cannot live without. I love retracement levels. So when there's a retracement level that is very close to the moving average area, that of course indicates that it has a good chance of survival. Trend lines before they are broken, before the moving average is penetrated or failed at. When this happens, of course, when the moving average is very close to trend lines, that is great. Overbought and oversold readings, they can be very helpful too. When the market is starting to move away from one of them while failing at a moving average band, moving average area, that of course is another reason to believe in the direction. Candles, I love candles. I use candles all the time, just as much as I use retracement levels. They are among my top favorite tools to use. And when you see a reversal candle inside or very close to the moving average band, that further confirms the possibility of a reversal. After testing, of course, I want to see the candles after the moving average band is tested. How is it the hour closing? How is the 4-hour period closing? How is the day closing? When it closes, I go to the candle chart and I see what is happening there, and I want to find out if the candle shape or a pattern supports my idea, my understanding of a reversal very close to the moving average band or not. And of course, even after we start moving away from the moving average band, I want to take a look at the trend lines, not only before but after. The move away from the moving average band should be drawn within trend lines or channels, and then we see how the price reacts to these trend lines or channels. And of course, Elliott wave count, if you know how to count the waves, especially the ABC pattern, that can be very, very helpful. So here's the strategy, guys. First of all, I use the simple moving average 35 and the simple moving average 49 on the candlestick chart. And I colored them just like this. I always color the simple moving average 35 in blue. And I'm sure you have noticed that in my analysis sessions. The simple moving average 49 in red. And it's always the candlestick chart, not the bar chart. After a move up, wait. Of course, we're talking about the bullish setup. Now, these are the conditions to initiate a long position. After a move up, wait for the price move up, I mean above the moving average band. I'm sorry if that's not very clear here, but this is what I mean. I mean, after move up, we are above the moving average band. Wait for the price to retrace back down to anywhere on, which means a touch, or inside the area between these two moving averages. So we need to see a move down. This is something that I want to see. I want to see the price, after reaching higher, moving down towards this moving average band. Now, another thing that I really want to see is no close below the bottom of the moving average area during the current price move. So when the price starts falling, if we find support above the moving average band, that's great. If we find support inside the moving average band, that's even better, because it's clearer to see, easier to initiate long position. But or even if I see a little bit of the price moving below the moving average band, that's okay, but without a close. I don't want to see the candle closing below the moving average band. And after I get all of these things, you know, the drop, which is a touch or inside the moving average band with no close, and of course I will be using the 35 and 49. After I get what I want here, I'm going to check for one of these three situations on the close, and only on the close. When the candle is going up and down, you do nothing. You wait for the candle to close, and on the close, you take a look at this close and compare it to the moving average band. And if you get one of these three situations, you initiate a long position. Let's see what they are. A close above the top, not the bottom, the top of the moving average area, or a green candle, or a bullish candle, even if it was not green. Like, of course, a doji, it does not have a body, so it's not a green candle. A hammer can be green or red, and it will have, of course, the same understanding, the same meaning. Or spinning top, a candle with very small body, the color does not matter here. So initiate a long position buy on the close of the first candle that fits any of these criteria. Now, what about the stop and limit? The stop should be below the bottom of the MA area. Of course, with the close is preferred. Sometimes you can't wait for the close, but the close is preferred. When you can wait for it, it's better than just placing it there below the moving average area. And the limit should be above the previous price top. How's that? Not very complicated, right? It's not very complicated. It's something you can follow. Now, the bearish setup, of course, we use the same things, same simple moving average 35, 49 candlestick chart. Now things are in reverse, so we need a move down, not up, and we wait after that move down for the price to retrace back up, touching the moving average band or going inside it. Both cases are perfectly fine, but we need to see this move with no close above the top of the moving average area. So we reach the top of the moving average area, that's okay. If there's only a shadow above it, that's okay, but no closing above it. I don't want to see a candle close above the top of this moving average area. And after that, if we get this, if this is what we are seeing on the chart, we look for one of these three situations: a close below the bottom of the moving average area, a red candle, a bearish candle, even if it was not red like a doji, a shooting star, the color does not matter in a shooting star, or spinning top, of course the color does not matter there. And we initiate short position on the close of the first candle that fits any one of these criteria. The stop should be above the top of the moving average area. Well, and of course we prefer to wait for a close, but sometimes we can, sometimes we can't. It depends on the size of the move above the moving average band. If it's within reasonable moves, then we wait for the close. But if it's starting to get out of control, of course we don't wait for the close. The limit should be below the previous price bottom. So the same thing, but in reverse, of course. Let's see how the setup's built on the chart. This is an initial example, guys. This is a 4-hour chart on the pound. We touched the moving average band. We were moving to the upside. Of course, we are above the moving average band, and then we dropped towards the moving average band, touching it like here, or going inside it. Both are okay. And then we wait for one of the 3 conditions that we talked about. And here we do have not only a green candle, but it's only engulfing, an engulfing pattern. It's a positive, bullish engulfing pattern. And of course, it's a reason to go long. The engulfing pattern by itself is a reason to go long. So when it happens very close to a moving average band, that is a double reason why you should go long. So immediately when this candle closes, we get in. We touch the moving average band. We have ourselves a bullish candle here. We get in. And now that's why I call it the trigger candle. So the trigger candle is the candle that when it's closed, it gives us the chance to get in. It confirms that we should get in the market. Now the target should be above the previous price top. This is the previous price top. So I buy here at the close of this candle. My target should not be here, not here, not here, not here, not here. Above it. How much above it? You know, this strategy by itself does not specify that. Specify that at least you are going to target levels that are above the previous price top. You can use, of course, other technical tools to identify that, previous tops and bottoms, retracement levels, or you can make it very simple and place that maybe 10 or 20 pips above the previous price top, and then that's it. You say to yourself, for example, this is 31.10, for example, I place it at 31.30, and that's it. Okay, now the stop is below the moving average band. So this is when you get in here, you look at the moving average band. Where's the bottom of the moving average band? Let's say it's 29.70. I place my stop with a reasonable number below that, which of course is not the same for every instrument. For instruments that are volatile, we prefer to use 30, 40. For instruments that are not very volatile, 20 and maybe sometimes even 10. For instruments that are very slow, like for example the New Zealand dollar or the Euro Swissy, 10 pips are enough for these pairs. So this is it, guys. This is your stop area, this is your target area, this is your trigger candle, and I hope that this strategy is now clear. This is the bearish setup. As you can see, we were below the moving average band, and we started rising inside. When we got inside this moving average, look at this. We touched it with a green candle. We got inside here with a green candle, another green candle, another green candle. So all of these green candles are not very supportive of a drop. But the minute we see a spinning top with a red color, that of course favors the downside, especially that it happened inside the moving average band. I love that when it happens. When I find a sign of reversal inside the moving average band, I get so excited because most of the time that can lead you to profit easily and in a short amount of time. This is, of course, our trigger candle. When this closes, we sell with a stop, of course, above the top of the moving average band. This is the top here. We place the stop above it with a number of pips that is different from one instrument to another. You can, of course, by now you know how I use things, and you can, of course, use them in the same way. I use euro, maybe 20, but if it's gold, 40, and so on. And after that, of course, the target area should be below the previous price bottom. This is the previous price bottom, the lowest price seen before going back to the moving average band. So we get here, we got to 111 here. We got up to 1160 or something like that, and then we started falling. Your target should be below 111. So it's not here. When you sell here, we don't close here, we don't close here, we don't close here, we close here, just below it. How do we specify how much below it? Well, of course, you have many technical tools. If you find, for example, daily lows there, daily highs, retracement levels, trend lines, you can use these to specify the target. But if you want to keep it very simple, just place it 10, 20 pips. Of course, that also is different from one instrument to another. If it was euro, maybe 20 pips is okay. But if it was gold, maybe I'll place it at 40 pips below the previous, or 50 below the previous price bottom. So it's different from one instrument to another. So this is your stop area. This is your target area. And as you can see, the price dropped to its target easily. And these two setups here, they make it look like magic. You know, it's very easy to make money with this strategy. But of course, there is no strategy that works all the time. In my own opinion and from my own experience, this is one of the best strategies you can follow. And most of the time it's going to give you fantastic trading entries, and the targets will not take a long time to be hit. But of course, sometimes you do everything right, you do everything in the right way, only to end up with a loss. And of course, that's a part of trading. Even if you are following the strategy perfectly, even if you are a great analyst, great trader, you found a great strategy, you follow it all the time, you make money most of the time, but not all of the time. Nobody makes money all the time. Nobody makes profit every day. Nobody makes profit on every trade. Nobody makes profit every month. Nobody does that. And you have legends. You have people who made miracles in the market admitting that, yeah, sometimes we lose money, sometimes we make money. But the difference is, of course, is as George Soros best put it, he said, it's not that you are right or wrong that is important. It is how much money you make when you are right and how much money you lose when you are wrong. One of the best quotes for you traders out there. So if you are, when you're wrong, if you are losing only a little bit, and when you are right, you are making good money, you will be a fantastic trader. But if you are making 20 pips on your good trades, the winners, and then you're losing 150 on your losers, you will never ever make it in this business. So it's very simple to say, but I know it's harder to implement, because when you are in loss, the feelings, human nature is trying to push you to do mistakes by telling you, no, wait, we don't have to get out here. Maybe things will get better. There is no hope in the market. You don't hope. You have levels. If we are above the support that we are counting on, you hold on to your trade. If that support is broken, there's no need to wait for 150 pips below that, causing you huge losses that can eat the profit of 6, 7, 8, 9 trades in a row. You're making fantastic trades one after the other. You're having a wonderful week. A winner of 20, 18, 25, 30, 15, 20 again, and then one loss of 150 pips, and you are devastated. You will start feeling like it's the end of the world. So there is absolutely no strategy that works all the time, definitely. But this one has a fantastic ratio, in my opinion. It's minimum 80% of the time. And of course, it's not on this number is not based on a study. It is based on experience, you know. Minimum of 80%. This is what I believe that this strategy can give you, a minimum of 80% correct entries. But still, of course, sometimes you are making 20% of the time, you are making exactly what I have told you here, and you will end up with loss. And that's fine, because I'm making profit on 80%. So it's okay to lose on 20% of the time. Don't you agree, guys? Blaine is hungry, so we need to take a break. I am thirsty. I'm not hungry. I'm going to get myself something to drink. I have had my tea, my morning tea. Now I want to drink something else, because, you know, you need to hydrate, especially when you are talking as much as I do. So, guys, we'll be taking 5. Enjoy your pizza, Nick. Here, Thank you, buddy, for offering me some, but here it's still too early for pizza. It's 10 a.m., so I'm only having my tea. This is how I start my day, tea, and then I'll get a little something to bite on until the end of the webinar. So you guys, we're going to take a break. After the break, the last part when we will be talking about the strategy, I'm going to show you examples. I'm going to show you screenshots, and I'm going to show you examples live on the chart in front of you in today's charts of such setups. Okay, so with this, guys, I want you to relax for a few minutes. I want you to enjoy a break of 5, 6, 7 minutes, something like that, until I get myself something to drink and maybe quick, very quick bite. Not pizza, Nick. I'm gonna get something faster, much faster than that. And I'll be back, guys. I'll be back after this break. Meanwhile, please allow me to thank QTime FX, our Forex broker, our favorite Forex broker in the whole world, who is offering you a maximum leverage of 500 to 1. Our broker, we are very proud of our broker for getting the prize for the low, or the award for the lowest Forex spread broker of 2018. They are offering you 0.4 of a pip on the euro dollar and the dollar yen with zero commission, guys. Client safety of funds, segregated client funds, and UOB, one of the top banks in the world. It's ranked number 22nd in World Bank ranking. So we are doing this the real professional way, guys. And of course, we are offering you $500 in bonus. Not only that, we have another offer of $250 if you don't want to deposit too much. So what are you waiting for, guys? Contact us at fx_educast via Telegram, and let's open this account for you. Meanwhile, a quick break and we will be back. Love you guys. See you after the break. Okay, guys, how's everybody doing? How is everybody doing? I really hope you're doing great. And now we are back. Of course, we are in the third hour. And the first thing I'm going to start with is a continuation of the strategy we were talking about. Let me continue from where we stopped before you forget. And of course, we are going to move after talking about the setup. This is a beautiful setup. Now I'm going to show you some examples, guys, and then we will be done with this strategy. So this is the bullish setup, touching the area inside it or just at it. It's both valid. And then a trigger candle. We need to see a trigger candle. Target, of course, above the previous top, and stop below the moving average area. The bear setup is, of course, a reverse of that. The trigger candle, we should drop below the previous price bottom, and our stop should be above the moving average band. Test your skills, guys. Can you see the setups? Can you see them? I'm gonna focus on the chart here so you can see the setups. Do you see what I'm talking about? There is two trading opportunities on this chart. Can you see that? If you can, please let me know in the comments. If you are not seeing it, I'm going to explain it in a minute. So take a look at it. I'm going to give you a few seconds and then I'm going to give you the answer. So any answers? Any thoughts? Okay, then let me explain them to you. Maybe I didn't give you enough time. So, guys, of course, you remember the setup. We said that we need to see the price moving above the moving average band and then dropping towards it. And this is what happened here. Here, guys, this is the first setup, of course. We were above it, we started falling, and then we are inside the moving average band. And when you find support inside the moving average band, you should expect the price to start moving higher. And the target, of course, should be above this one. Now, where is my trigger candle? This is a tricky question. Is this enough? Well, maybe yes, but to me, no. I want to see the price do better than this. This is, we can call this a piercing pattern, but to me, it is 50-50. But here, you know, with the long lower shadow and the small body towards the top of the range, this is my boom. So at the second candle, when this closes in this way, after I see this long shadow to the downside, once this candle closes, boom, I get in. And my target would be above the stop here, and my stop, of course, below here, below the moving average band. The numbers, again, the number of pips above the previous top or below the moving average, of course, it's different from one instrument to another. Instruments that are volatile, we need to use more pips. Instruments that do not move much, we can use smaller pips in the stop and in the limit. So we buy here at the close of this candle with the target above here. And as you can see, guys, we did meet our target. This is the Canadian dollar against Japanese yen candle for our chart. And again, guys, here we do have another setup, and we have more than one trigger candle here. Let me talk to you about the importance of picking the right trigger candle. Now, here of course, we were above the moving average band. We started falling. We fell inside the moving average band and we closed well above it. This is bullish, of course, because I have a long lower shadow to the downside, and at the same time, this happened very close, very, very close to the bottom of the moving average band. So overall, this is a fantastic position to be in. Of course, on the close of this candle, this looks at first sight fantastic to get in. But look at this, guys. The target should be here, and the candle closed here. Look at the distance. It's very, very close, around 20 pips or so. So is this the kind of trade you want to be in? Or do you want to get in at a better price? This is a question. So when the trigger candle closes very close to its target, then you don't do anything. You just wait for a better signal, better trigger candle. And this is exactly what happened here. Again, we dropped. Why? Because of course we recovered very fastly, and we closed here. Now we dropped towards the moving average band again. Here we have a long red candle to the downside, no reason to buy. But this, look at this beauty here. Very, very small body, reaching a low that has not been reached before, even below this one, and closing, although we have traded below the bottom of the moving average band, of course we did not close below the bottom, so we still have the bullish sentiment there, the bullish spirit. The spirit of the bull is attacking the market. So on the close of this candle, to me, it is much better a trigger candle than the close of this candle. So here, yeah, of course, I have a long shadow to the downside. If this top was very high, higher than the entry here, that would be great. But since the entry to my trigger candle here is very close to this previous top, which is, of course, the border for the limit, for the target for this move, they are very close to each other. So I wait for a better opportunity, and it comes, it happens here, and then of course we buy on the close of this candle with a limit that is above this top, and here we reach that limit just above this top before falling again. This is also another example on the euro, and here you will not be blamed if you want to just let this go. You say to yourself, well, we are here, we dropped horizontally, we touched the moving average band, this is great, but look at this. After such a move, a strong move to the upside, our target is very, very near. So you can use this, or you can, of course, you will not be blamed at all if you said to yourself, well, I don't want to get in here. You would be doing the right thing. And sometimes when you follow the rules exactly, you're not going to be happy about what the market is doing. Of course, no strategy is right all the time. So if you get in here, of course, this is a trigger candle, but you may say to yourself, well, the limit area is very close, so I don't want to get in here and get out here. That's a very small target. I will look for a better entry point. Nobody can blame you for that. And after that, of course, as you can see, the price moves to the upside. This is a perfect example. This is the daily chart on the New Zealand dollar. As you can see, guys, we are below the moving average band. We are rising to levels inside the moving average band, and here, as you can see, the price starts to show signs of weakness. Of course, smaller bodies are signs of weakness. When you have spinning tops like this after a move, that means there's a probability of moving to the other side. This by itself is a sign of weakness. So how about having this sign of weakness, inside the moving average band, which is our dynamic support or resistance area. In this case, of course, it's a resistance area. This is a dynamic resistance area that we value very highly, and we love our moving averages. So when we find a reversal sign inside the moving average band, that is double the pleasure, So when I see this, I immediately go short, immediately. We were below, we started recovering. We got inside the moving average band, and we started showing signs of weakness. Where is your trigger candle? Where there is a number of trigger candles here, of course. The first one is this. This could be a shooting star because we have a long upper shadow, small body near the bottom of the range, a very small or no lower shadow, and it came, of course, after a rising move. So this is a shooting star, and this is our initial trigger candle. When this candle closed, you can initiate your short position. Well, to some people, maybe because it's green, they say, of course, the green does not matter. And in a shooting star, the color does not matter. But to some people, they want to see something red before they commit themselves to a short position. So the next candle is red. Maybe here you sold, maybe here, especially with the long upper shadow. This is something like a shooting star, but it's red. Here it's green. Maybe this gives you more confidence that the market's going down. Or maybe the very, very careful traders, they want to see the price move to the downside below the moving average area. And these traders can sell here at the close of this candle. Finally, a strong move to the downside that took us below the moving average band, and you can sell here. In all cases, this trigger candle or this trigger candle or this trigger candle, in all cases, you have met your target easily and you exceeded it very, very well. This was a great trading opportunity here. Again, guys, we dropped, we started recovering. This recovery bumped into the moving average band. And here, to me, this is the trigger. Of course, this is the first trigger. After trading inside the moving average area for just a little bit, we dropped and we closed below it. And with a long, strong red candle at the close of this red candle, this is my short position, my short opportunity. I have an opportunity here to sell. I initiate my position, I get in the market, and of course my target should be below this bottom here in these areas. I look for something, a retracement level, a previous high or low, anything, trend line, anything that can help me identify a target as long as it's below this bottom. I don't want my target to be above this bottom, okay? I want it to be below it. 10 pips, 20 pips, 30 pips below it, anything. The most important thing is to have it below. And if you did not use this, again, the price tried to overcome the moving average band and failed here with this spinning top, very obviously. This is, of course, a bearish candle setup. As you can see, rising, then spinning top, then a red candle, green candle, spinning top, red candle. This is a setup that I really believe in. And of course, here you can sell as well. And in both cases, you have reached your target. Of course, the stop here would be above the moving average band. You need to place your stop in these areas. And as you can see on the chart, we did not even come close to that area. Again, guys, it happened for a third time. Here we touched, here we did. Just look at this, guys. This is important to me. When we do not touch the moving average band, you wait, you don't do anything. You need to see at least a touch or the price moving inside the moving average band. So here, although this is a doji, if you want to use the moving average strategy, you do nothing. But if you want to trade candles, of course, the candle by itself here is a sell signal. But if you want to use the moving average strategy, you wait until it is at least touched like this. Here, after the touch, we have a spinning top, we have a doji, and this is your trigger candle. Of course, we closed below the bottom of the moving average band, and very small body, long shadows up and down. That is an indication of reversal after this recovery attempt. Reversal, that means going down again. And of course, your target should be below this bottom, and we did, as you can see, we did reach levels below this bottom. Our stop, of course, should be above the top of the moving average area with a number of pips. That depends on the instrument itself. Okay, guys, so now I'm gonna take a look at I'm going to delete all of this. Or actually, there's no need to delete it. We were talking about gold before the break. So I'm going to show you some setups that are using the same exact strategy. For example, here we were trading below the moving average band and we rose towards the moving average band. Here inside we traded inside it. Now with a piercing candle, this is the first red candle, a trigger candle, as explained in the, remember before the break we said a red candle after trading inside it, or a bearish pattern, or a closing below the moving average band. These are the three cases, and of course we need only one of them. We don't need all three of them to happen. Any one of them that happens, that means you have a trigger candle. This is your trigger candle here. It's a piercing pattern and it's a red candle inside the moving average band. So we sell here at around 1490. The close is exactly, if you want to be exact, 89.3. So we sell at 89.3. Our stop should be above the moving average area here. The top of the moving average area is around 94.5. So I need to place it maybe 30, 40 pips above that, which leaves me with a stop of maybe 90 pips, something like that. My limit should be below this one. So this low here is 79.20. So I sell at 89, actually 89, the close is 89.70, not 30, the low is 30. The close is 70, so I sell at 89.70, as you can see. And my limit should be below 14.79. How much below? Well, if you want to keep things simple, you can place it. It's gold. It's a volatile instrument. You can place 40 or 50 pips below that. So it's 75, 74, something like that. Selling from 89, guys. So we are talking about 140 pips of profit, which would have been reached here. You see, it did not take a long time for for this, yeah, around here. So it took, this is November 6th at 12. This is November 7th at 10. So 22 hours, you were making a profit of more than 100 pips. That's fantastic. Again, guys, we do have another setup here. As you can see, of course, we were dropping and then we started recovering. The recovery went higher inside the moving average band. We do have our trigger candle in this, of course, the spinning top and red candle. Or if you are the cautious kind of trader, you need to see the price moving below the bottom of the moving average band before you initiate your sell position. To me, this is right at the top. This is the trigger candle. And of course, your limit should be below this previous bottom. So the close here is 65.5. Okay, now the bottom, the previous bottom is 56. So 65.5 to 56, that is 95 pips, of course, but I don't use this bottom. I use levels that are below this bottom. If it was the euro, 10 or 20 pips, but if it was gold, I push more than that, 40 or 50 pips. So if I place 50 pips below this one, it means my limit would be 1451. I have sold at 65.50. I'm talking about 145 pips. And how many hours did it take us to get there, guys? Look at the magic. 1, 2, 3, 4, 5 hours. 145 pips in 5 hours. And some people ask me, is it reasonable to assume that you can make 1,000 pips a month trading? Of course it's reasonable. Of course it is. When you use these fantastic strategies, this is absolutely one of my favorite strategies, guys. And it is only because of QTime FX and FX Educast that you are getting this kind of information for free. I swear to you, my trainees, they pay thousands of dollars to get these informations. I swear to you. And you are getting it for free only because QTime FX wants you to make profit so bad. FX Educast cares about you. QTime FX cares about you. And Munther Marji cares about you. We all want you to make it in this market, guys. That's why we are offering you this very professional training, which costs thousands of dollars for free, because we love you, we want you to make money. Your broker, QTimeFX, loves you and want you to make money, and that's why they are offering you fantastic spreads, zero commission, bonuses, and training and trading sessions like this one. So now you know how to fish. I'm not giving you a fish, I am showing you how to fish yourself. So go to the sea and get yourself some fish. Okay, guys, so of course, one note before I terminate the talk about today's strategy is that the cross of the moving average band is also to the vast majority, to almost every analyst, the cross of the moving average band is something that is fantastic. It can provide you with fantastic trading opportunities. And to me, that is, it's like the flip side of the strategy. So my favorite strategy is to fail when the price fails to overcome the moving average, because it's a resistance or support. When it fails to overcome it, that means a reversal. Now, when the resistance or support is broken, that is also a signal in the direction of the break. In this case, we call it a cross, not a break, when we talk about the moving averages. So when we cross above the moving average, that is, of course, a reason to go long. But I did not explain this today because I wanted to focus on maybe I should not say this, but it's the better part of the two sides of this strategy. Cross or failure. To me, if I had to pick one of them, I would pick failure immediately. Does this mean I don't believe in crosses? Of course not. Crossing the moving average can provide you with fantastic trading opportunity. But this is my favorite part. This is my favorite half of this moving average cross and failure strategy. So there you go, guys. I really hope you enjoyed it. I really hope you understood it. Please, if you have any question, shoot. I'm here for another 25 minutes to answer all of your questions. And we are going to move to another instrument. We're going to don't want to waste any time. If you have questions, I'm going to answer them. If you don't, let's move to the next analysis. I'm going to read your comments. Paul, thank you very much. Paul is saying welcome. Thank you very much, buddy. I'm glad that you are enjoying this and that you are still with us for a third hour straight, because a lot of people don't have that kind of attention. They pay attention for 20-30 minutes and then that's it. If you want to learn something, of course you must be able, you will have to pay attention for an hour, 2 hours, 3 hours in a row with one thing on your mind. And in our case, of course, it is how to make money in this market. You should be able to sit through a webinar or seminar of 4 and 5 hours without being bored if you want to know how to trade. So huge kudos to you for sticking with us for 3 years. I hope we'll be 3 years together. For 3 hours in a row, I'm still in the weekend, guys. I'm still trying to convince myself that it's Monday. After the fun I had on the weekend, I spent the whole 2 days, Saturday and Sunday, out of the house, going from one place to another, sometimes with friends, sometimes with family, enjoying every minute. So I'm trying to convince myself that it is time to work. And as you can see, I'm trying hard. Okay. Michael, I wish I watched this 2 years ago. That is very, very flattering, buddy. I really appreciate your kind words. That is the kind of thing that makes me feel good about what I do. Making profit, when I withdraw profit, that is the best moment ever. But when somebody comes to you and tells you that they are benefiting from what you are presenting and they are making better results, that is the world to me. That means the world to me. I swear to you guys, because I have seen how many people lose money in the market so easily, sometimes so easily. People open accounts with $20,000 and they don't make it to a 1 month after that. They would be losing everything, making very naive mistakes that, of course, as a beginner, you are expected to make naive mistakes. But if you take the time to learn before you commit your money to trading, you will save yourself a lot of losses that the beginners always do. And I'm very sad to say this, but you know, if you go unprepared, if you want to get in the market unprepared, you will do these mistakes. So first, learn. Please, guys, read a lot of books, attend a lot of webinars. We are here for you. I'm here for you. FX Educast is here for you, and QTime FX is here for you. And on your own, go read a book. Get yourself some trading books. Read them. Get your hands on any source of information you can get. And after 19 years in the market with a Chartered Market Technician certificate, I am giving you the best that I can give. I'm giving you my experience and my education in order to make it easier for you guys to avoid the mistakes that a lot of beginners do. So we're here for you guys. We love you, want you to make money. Stick with us, and every day we're going to talk about a different strategy. Today's strategy is one of my absolute favorites. Tomorrow I'm going to think of something else. I'm still not decided. I'm going to see what I'm going to be talking about, and I'm going to show you another strategy on how to fish. I'm not going to give you a fish. I'm going to show you how to fish. So thank you very much for these kind words, Michael. Juliet is asking about the bonus. Of course, the guys at FX Educast are answering this. Thank you very much, guys. And thank you, FX Educast, for the nice words. Very, very nice, very kind words. Yeah, I'm trying my best to give the best strategies to our viewers. Blaine is very happy about the bonus. Yes, of course, man. $500. Who would not be happy about $500 given to them like this? For, you know, doing nothing. Just open an account with us and here's your money. So gold, yeah, we talked about gold before the break, Nick, and it's, as you can see, do you see what's happening to gold? We are at around 59 right now. We were at 63 when we started talking. We said that we are dropping towards the support 56.6 to 57.4, and now we are getting very close to there. And I really hope that we will get there before we reverse direction. Okay, so what I really want to take a look at in what's left of today's webinar is the pound. The pound, guys. The pound, we had a recommendation on Friday to buy at 29.04. Of course, maybe a lot of you guys got in and closed that before the weekend. That's fine, of course. We closed very close to the entry level, so no profit or loss, very few pips for this recommendation. But if you did not close it for the weekend, you would be a very happy man right now, because we are trading almost 50 pips in profit for this recommendation from Friday. 50 pips, guys. It was, of course, it was expected for the pound to move higher once we broke the resistance at 28.94. We said that on Friday. We said we have a resistance at 28.94. If we break that, then the market will continue moving to the upside. And this is exactly what happened. We broke above 28.49. And now, as you can see, guys, we are moving to the upside. Let me take a look at the hourly chart. Let me show you what happened when we broke our resistance. This was our resistance, as you can see. This was on Friday. Early on Friday, we broke above it. We got as high as 18 on Friday, and then we closed around 29. But today, we started on a high note. Since the open, we have been moving to the upside since the market opened last night. In my time zone, it was last night. To other people, it was in the morning, or maybe Sunday evening. If you are living in the United States. In Asia, it was already Monday morning. So since the market opened, it has been moving to the upside. Why is that? Of course, because we broke the resistance at 28.94. I'm gonna delete all drawing tools. I'm gonna show you why that was a resistance, and then we will continue talking about today. This was our resistance, guys, as you can see here. Once we broke it, we started moving to the upside. It was a Fibonacci level. Not stopping at a Fibonacci level is a sign that the market is moving to the upside. Let's see, where is the 78.6? It's already broken. 88.6. The market is trying to break it, so this is going to be our resistance for now. 29.52. We are at that resistance. Okay, and it's the only thing separating us from the 30s, because once we break the 88.6, the chances of reaching a high above the previous top would be really good chances. And of course, it's not a very far. 29.76, 29.52. We're talking about 24 pips. That's not a lot of market action. You know, that's not the kind of action you want to see. But what is better than that is that once we start trading above 29.76, of course, the psychological level at 30 would be very close, and we need to pay attention to it. We are expecting the market to trade in the 30s once we break 29.52. So 10 pips above that looks like a good long position. So buy at 29.52, that means 62. We are very close to that. We need a few pips in order to initiate this long position. But of course, before I issue this signal, we need to talk about the stop. And unfortunately, the stop is not very close. So along at 29.62, let me see what the best I can give you. If you want the real good stop, it should be below this trend line, but that would leave us with 120 pips or something like that. We don't want to be in that kind of situation. We want a smaller stop. The market, the last part of the move to the upside, the market has been moving higher since Thursday after some kind of horizontal sideways trading. Now, I'm going to look for the retracement level that is closest to the moving average band, and immediately I knew it was the 50%. That's why I placed this was my first pick. So the 50% level is at 28.92. As you can see, it's extremely close to the bottom of the moving average band. That's why I'm going to use it as my support for today. Let me just write this for you guys. Resistance is at 29.52. Support is at 92. 28.92. That makes a lot of sense. Okay, so of course with time, this is a rising trend line, and with time it's going to get closer and closer to 92 until they meet, but it's going to take some time until they meet. I think until tomorrow, or actually until Wednesday. So it's going to get closer and closer to 92, and making it more and more important. I'm going to use these two levels to build today's strategy for you guys. So buy 10 pips above the resistance with a stop 10 pips below the support. I'm thinking out loud. Let me see what size of stop that would leave me with. 80 pips. Okay, that's okay for me. Now let me look for targets. Target 1 and target 2. You see, guys, what I did here is that, of course, I need to focus on the chart in order to know where to get in and to get out. But then after I do that, I check my entry and stop with risk management rules that I have for myself. For me, I do not place stops that are very large. Some other traders, they do. They say, well, if we need to place a stop at 150 pips, we do, but maybe we'll lower the size of the trading position that we have. And of course, that makes sense. That's a good idea. To me, I prefer to keep my stop below 100 pips. That's why when I get, okay, I'm going to buy here, I'm going to put my stop here. This is what technical analysis says. Now, let me check with risk management. So it is not only analysis, you have to weigh that with risk management. So for me, I said to myself here, I have a buy at 29.62. My stop should be 10 pips below the support. That means 28.82. That is a good number for stop to me. It is within the rules that I allow for myself to risk. I don't allow for myself to risk 140, 150 pips, but 80, that is okay. So now targets, guys. Target 1, target 2, they both have to be, of course, above the 30. Maybe at the 30. What about that? 26 to 30. Well, that's just, I need to push it 10 pips above that or something. I'm trying to squeeze myself for you guys to convince myself of placing limits at 40 pips. I usually don't do that, but I know that you guys like that. From the feedback I got from some viewers, they say, well, your analysis is enjoyable. We like it very much. We use it in our trading, but your targets are always, large. They are huge for our trading style. So could you please give us smaller targets for people who like smaller targets? And I immediately said, yes, of course. I want to make things easier for you. So that is what I do. Okay, 78.6. All right. So a 78.6 is at 30.77. I'm not going to use that, of course, as a target 1. I'm going to use it as a target 2. And I'm going to look for something smaller for target 1. So it is 115 pips. That's great for a second target, but not for a first target. For a first target, I want something that is above here, maybe. What about this high? It is 30.13. Fantastic. 51 pips. Fantastic. 30.30. So this is my first recommendation for now on the pound. The second recommendation should be a short, of course. Now the question, it's a very important question. Should we sell? I don't want to lose this, so I want to keep it here. Should we sell if we break below the 50% level or the rising trend line? In my own opinion, I would prefer to wait for the trend line itself. So I'm going to check and see. How about 61.8? No, it is still far from the trend line. I want something that is very close to the trend line. And I got the 71.4 at 28.62. So I'm going to use 28.62 as the support to sell if broken. And I'm going to start building that strategy. Sell below this level. 28.62, that means 28.52, 10 pips below that. It's the pound. It's a little bit more volatile than the euro, so I'm going to use 20. So sell at 28.42, which is obviously very far from the current market level, but this is what the technical analysis is suggesting. I don't want to be short above this rising trend line. This is a rising trend line. If it's not broken, I don't want to be on a short position. I may close my long position for risk management reasons, not for analysis reasons, but I don't want to be short. Now our stop, let's look for our stop. If we sell below this trend line, then the price would be dropping from here to here and here. With this, with assuming this, then maybe here or something like that, I can calculate retracement levels on an assumption, of course. How about 61.8? It would be at 29.20. So 29.20. 20 pips above that, 29.40. It is still below 100 pips. It's okay. It's a little bit larger than what I wanted, but It is, okay, target 1 and target 2. Target 2 is obviously going to be 27. It's a retracement level that I'm very interested in. We talked about it many times recently. I'm going to show you why it is important in a second. This is the last part of the recovery attempt, right? This is 27, guys. It's the 38.2 Fibonacci level for the last part of this recovery attempt, 27. That's why it's going to be my downside target for the time being. It is the first Fibonacci level. I like it very much, but I need a closer target. And for that, I'm gonna look, of course, how about this bottom here? Because of course, if we break this trend line, there's a chance of moving lower and reaching a lower low below this bottom. This bottom is 27.67. No, it is too much. I want something that is less than that. I'm going to use retracement levels again, my favorite tool in the whole world. As you can tell, I'm sure you can tell. Right, guys? Can you tell how much I love retracements? Okay, so 2809, no, 2789, that's it. That's the retracement level I'm looking for. So 53 pips on the first target, 142 pips on the second target. And this is it for the pound today, guys. Of course, I'm trying to combine analysis with strategy. So I talked to you about market analysis and I talked to you about strategy, and within 3 hours, of course, that means we are going to have to sacrifice some of the instruments we usually do. We usually do 6. Today, we only managed to talk about 3 because we devoted some time to talking about the moving average strategy, which I really believe can help your trading. And I really hope you enjoyed it and you understood it fully. If you did not, please go back to our YouTube channel, FX Educast, and watch this video again. It's going to be uploaded, of course, after this live stream. It's going to be there. You can watch it. You can go to the bits about the strategy, and maybe we're going to make a video only for the strategy and upload it later. You can check that back and you can watch it again and again until you feel like you understood it fully. If you have any question about it, please shoot here on the chat. You can contact me. You can find me on social media. I'm on Facebook, Twitter, and LinkedIn with my name, with my real name, of course. And I will be glad to help. I'm going to be here with you every day, helping you getting more information about the market, strategies, analysis, trading recommendations, everything I can do to help you achieve the kind of profit that you deserve. So let's meet again tomorrow, 21 hours from now, and we'll be talking, of course, about the same thing as we did today. We're going to devote some part, maybe around an hour or so, divided into 3 sessions to talk about strategy, and we're going to devote 2 hours to talking about the trading recommendations for tomorrow. For today, these are the recommendations I'm going to leave you with. We talked about the euro, we gave recommendations there. We talked about gold, we gave recommendations there. And as you can see, gold is dropping towards our support area. We are waiting there with an entry, a buy at 1457.2. I hope it will be triggered. I really do, because I believe we can find some kind of support there and some kind of reversal. So keep your fingers crossed for me. If you see gold reaching 1457.56 and then rising again, then you know that I will be a very happy man. For the pound, the last recommendation for today, we have a long at 29.62. We are getting very, very close to triggering that. As you can see, the current market price is 55.56. Stop 28.82. Target 1, 30.13. Target 2, 30.77. The sell is at 28.42 with a stop that is very close to 100 pips. So be careful with that. 29.40. Initial target 27.89, and the second target is 27. And before I do leave, I just want to place these orders on my trading account and say goodbye to you guys after that. So we are buying at 129.62, very close to that. We are currently very close to that. I don't want to miss that. 28.82 is our stop, and our limit, guys, is 30.13. Yeah, that's good enough for me. Although I feel like I want to put 77, but it's okay for you guys who like the small targets. So 30.13, there you go, and place. We are now have an order. We should also sell stop. Let me remember the numbers. Let me read them again. 28.42 with a stop at 29.40, and the limit, our limit, is going to be 27.89. And boom, place. So now we have targets to use any move, breaking any one of the levels we talked about today on euro, gold, and pound. And we learned a lot about the moving average strategy. I hope you got that into your head and you liked it as much as I do like it. With this, guys, we come to the end of today's webinar. It has been a pleasure. I cannot believe we have already made it to the end of the third hour. I felt like this is only 40 minutes or so because I enjoyed every minute with you guys. Gabrielle, thank you very, very much. And Blaine, welcome, buddy. See you again tomorrow, of course, with new strategy, with new trading recommendations. So enjoy the rest of your day, evening, morning, afternoon, night, whatever it is, wherever you are. I know I have viewers in different places of the world, Asia and Middle East. Most of you are from Asia and Middle East, and I'm very happy about having my viewers from anywhere in the world. Most of you come from these two places, but of course, when I see a viewer from any place in the world, I'm very happy with you, very honored to have you here. Some of you are from Europe, so welcome. Some of you are from Africa. Of course, I have very good friends there and clients. They know themselves. I don't want to name names. And Middle East, Asia, and a little bit from Europe as well. Very happy with all of you guys. Very, very happy. Keep me happy tomorrow. When we meet again, 21 hours from now, we'll talk about today's recommendations, what happened to them. We'll take a look at the technical outlook for the major instruments that you care about. And of course, we'll have a portion of tomorrow's webinar devoted for some trading strategy. I still did not pick which strategy I'm going to be talking about. I'm going to prepare the material later today, and I promise you, even if I don't know which strategy, I promise you that it's going to make your trading better. Okay, guys? So with this, I am very, very happy to have spent all this time with you. What I want to finish with is, of course, a big, big thank you to QTime FX, our favorite broker in the whole world, and FX Educast, of course, because they are the reasons why we are here, guys. They are the reasons why you are getting this for free. I swear to you, this costs thousands upon thousands of dollars in my training courses. I offer training courses and they are very expensive. They are, everything I have said here is free because of QTime FX, our favorite Forex broker in the whole world, offering you a leverage of up to 500 to 1. You want to be opening your account with the broker who won the award for the lowest Forex spread broker of 2018. Imagine yourself trading with spreads like this, 0.4 pip on the euro dollar and the dollar yen with zero commission, of course. If we charged commission, that would not be a huge advantage. But when you trade with such very attractive spreads and no commission at all, then you know that you are trading with a world leader a great broker who is offering you fantastic trading conditions that every trader would love. And on the top of that, of course, we have the bonus offer, which is currently going on for us $500 or $250. So contact us at fx_educast via Telegram, and let's open this account for you. For time being, it is time to say goodbye, and we'll meet again tomorrow, guys. Love you all very much. See you in 21 hours with much more exciting market related topics. Take care. Bye bye. See you tomorrow.